Good evening, everyone, and welcome to this edition of the BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia. My name is Roshan, Kanesan, and today, like I mentioned just a few seconds ago, we're taking a look at what you should do if cash is tight and you have a regular investment plan. Should you hit pause on that? And well, to help me with this, I have Pauline, Yong, licensed financial planner with Sigma Wealth here, as well as Wong Wai Ken, Malaysia country manager of StashAway, and as usual, co-moderating this with me, Malek Ali, founder of BFM Radio and filife. The three of you, a very good evening, and thank you for joining me today.
Good evening, Roshan.
Good evening, Roshan.
So I think let's just kick right into the main question here. Pauline, if you don't mind, I'd like to start with you, getting your perspective here. If money is tight, should I pause on investing? Actually, wait, hold that thought. If you have any questions, please feel free to ask in the comment section down below. We're more than happy to take as many questions as we can. And be sure to ask as early as possible so that we can integrate it throughout the show. Now, sorry, Pauline. Now, what should I do if money is tight? Should I be pausing my investment plan?
Yeah, actually, when we look at the current investment environment, we are in the COVID environment. So a lot of time in this kind of environment, people are losing their jobs. And if you are looking at you are losing your job and then you have your liquidity is in a tight position, that means your cash flow is in tight position, then you will have to look after your own finances first. Okay, so that means if you really lost your job and then you have do not have much of a liquidity, then you need to maybe you need to take a pause. Okay, but however, if you to look at the historically, usually when we look at the investment return during this recession year, and then a few years later when we look back, we'll see that these are the good times for investment. So if you really you do not have that kind of a liquidity crunch, maybe you can continue with the investment. Yeah, I would think it would be the good time to invest.
Yeah, I think that's something we've seen in the past, right? I mean, if you look on the back of the global financial crisis, that's when you could get some of the big American banks for a fraction of what they are today. Ken, let's get your view on this as well, because I know this is something that StashAway looks at as well, right? These regular investments, and I'm sure a lot of your own clients have regular investment plans. What should I do if money is tight? Should I be pausing these investments? And maybe have you seen any behavior like that on your platform?
Yep. Thanks, Roshan, and Salam Merdeka, everyone. I hope everyone had a really good long weekend. I think for those of us who still have our jobs, we have to be very grateful because there are people out there who are hurting, which is why I think today's chat is very valuable, right? So if money is tight, should you pause on investing? So in my view, it really depends on your situation. I think a lot of the times when we are in a crisis mode, people think that we should be doing things differently, but actually the opposite is true. You should be doing good things all the time, regardless of the situation, right? And it's even more important that we revisit those fundamentals in these tough times. So as a rule of thumb, we always advocate people have a safety net of at least 6 months savings for their expenses. Say if you're younger, 6 months is more than enough. If you're 35 and above with kids, then 12 months safety net is actually really good. But if let's say you're a business owner, say for example, Malek, actually you should have more savings because your business, your family, yourself all rely on your savings. So we actually advocate 2 to 3 years of savings in cash if you have all those extended responsibilities, right? Because bear markets tend to last 2 to 3 years. So in the worst time, you don't want to be cutting staff and having your family make too much sacrifices. So safety net number 1 is really important. And then you have to do a stock take on whether you have truly optimized your lifestyle. I think sometimes people live their lives and there's a lot of fat in their livelihood. So have you really reduced all the unnecessary expenses? Small things like, memberships and subscriptions really add up. And then, are you still going on holidays? Are you still taking personal loans and things like that to do things that you're not supposed to do? Have you cut that all out? That's necessary, right? Before you even cut on your investing. And also it really depends on your job profile, right? I think Pauline mentioned that some of our clients have lost their jobs, unfortunately, right? And it depends if you are still working, if you have a steady job versus if you have a job that is commission-based, right? So if let's say you're someone with a steady job, basically you're like a bond, every month you have a return, right? So I think it's best if you're still working to continue investing. But let's say you're commission-based and you're selling real estate, then and things are not going so well, then you might actually look at putting the pause button. So if you say yes to all three, meaning you have a safety net, you have a stable job, and you have reduced all your unnecessary expenditures, then I think it's a good idea to continue investing.
I think that's where it gets tricky, right? If you have one or two or three, not three. If you have three, the answer is quite clear. If you have one or two and you're in a very uncertain situation, I think that's why people are asking this question right now. Because even if you have a stable job, you're concerned over what could happen, and maybe you want to conserve as much cash as you can at this point, and that's why we think about whether to pause. I think if you've lost your job, you have to do whatever you can to conserve cash in that moment, right? Because Ken, you brought up something very interesting. The 6 month savings that you have, that cash buffer, we typically think of it as 6 months expenses, right? Do we consider investing as part of that cash buffer? So I don't think many of us do, right? Because I personally haven't done that. And it's just something I've just started thinking about. Now, Pauline, I think Ken went through some very, his own structure of the factors that go into a decision like this. Is there anything that you would like to add to that? What do you think are the main factors involved in making a decision like this?
Yeah, if you were to look at we need to take care of our own finances first in any situation. So the liquidity is one thing, and then we also need to look at the commitment that we want to put in our investment, because very often investing is not about getting the right timing. It's not about you pick the right stock, or it's about being able to be committed into doing something. Okay, so I would think that this regular investment plan is a good form of investment strategy. It's a strategy whereby it's for long term. So if you're committed to invest on a consistent basis, you will be able to reap the reward in the later years. So I would definitely, recommend that people stay in the investment, even when you are really tight cash. But then it's better for you to stay in rather than pause, unless the situation is really at your disadvantage, then you are forced to pause it. Otherwise, it's always good to stay in and be committed to your investment.
So Pauline, what would you say are some of the alternatives then? Ken mentioned a bit earlier, just cutting some of the fat off the expenses and, really just analyzing what we spend our money on. What are the typical alternatives that you would say people should cut out first before getting to something like as big as your investment plan? What have you observed in your clients, for example?
So like what Ken has said, the expenses and the emergency fund, all this we have to look first, and then the next alternative source will be your insurance policy cash value, because a lot of time the cash value does serve as an emergency fund if, let's say, you are in a very tight cash position. So maybe that is one form of alternative where you can look into. And but of course you must also look at your policy, whereby you do not want to sacrifice your medical and all the benefits, because purely looking at that cash value first. And so another alternative, maybe you could borrow money from your friends or relatives, so that also another alternative. So in a very often we will look into what we have as a surrounding, what are the sources that we have, and then we move on to the next level. Yeah.
Right. And I think if you take a look, we discussed the insurance part of this equation 2 weeks ago. So if you go through the Facebook Live or our BFM videos, you should be able to find that. That was about 2 weeks ago. Malek, you have a point to bring up.
Yeah, so there's a question from Facebook, basically. We were talking about having cash. all the way from 6 months all the way to Ken's 2 to 3 years cash if you own a business. Oops, thank you, Ken. Thanks for scaring me. But I think there's a question by links is what do you put your cash in? I mean, basically, do you put it in FD? Do you put it in savings? What for this emergency funds? Do you get suggestions?
Yeah,
or do you or just put a plug for it? Now, do you put it in StashAway Simple?
Yeah, that's an alternative as well. I think what you have to look at for your emergency fund is something that is ultra low risk. So FDs is perfectly fine. You know, you have to deal with those lockups and some terms and conditions. High savings yield, high yield savings accounts are also a good idea. There are some out there, but be very careful about the cross-selling. And also, of course, like you mentioned, StashAway Simple is essentially a money market fund with a projected yield of 2.4%. And that's also a ultra low risk where you can park your emergency cash.
Okay, how long does it take to I mean, if I were to put money in StashAway Simple and I wanted it, say, oh, I have to spend on something now, I have to pay off something, how long would it take?
So it's when you invest, it's T+3. When you withdraw, it's T+2. So you can get it fairly quickly with some advanced planning.
Okay, we'll do. There's also another question by Brian Koo. He says here, market is not conducive. And I think this is a feeling of a lot of people. Basically, the share market is disengaged from the real economy. The real economy is crashing and burning, but the markets are sort of bubbling in a way. So, what kind of investment will you guys be recommending, and the expected rate of return? So, I mean, in this sort of very sort of in a market which is as it says disengaged from the real economy, what kind of investments are you looking at, right? So here we're talking about people who do not need to pause investments and they actually want to go in now. What would you recommend?
Yeah, I'll take that if you don't mind. Also, obviously, I'll keep this short. I'm sure Pauline has a lot to add as well. So I think when it comes to the dislocation between the economy and the actual market itself, that's why it's actually really important to be investing for the long term, because the rules about investing change all the time. So it's not like you can learn one style and forever make money. For example, if you were a value investor, you'd find it very hard pressed to find great opportunities in the last few years because everything seems so expensive and it kept going up and up and up until COVID. And then COVID hit and you thought you could bottom feed, right? Find some value, and then within a month it was all gone, right? And now we are back to all-time highs, 60% up from March. So I think it's about that long-term commitment like we talked about, and doing that actually helps you eliminate the risk of you having to change your style so often. So coming back to the question about what expected returns are there, right now the expectations for risk-free assets is really low, right? Because OPRs are very low, interest rates are virtually zero. FDs go for 1.8% right now. If you take a little bit more risk, you can look at a money market fund, which gives you around 2%. Gold is doing quite well. The last 10 years, given about 7%, US stocks around 11% the last 10 years, including the dip and the recovery in COVID. So bonds in there will give you around 3%. These are international bonds, a bit on the low yield side. So the key is not actually to jump around into the hottest asset, right? Because if you did that, you'll be jumping from Bitcoin to Tesla to Top Glove and all the rest, and you would always be schizophrenic because you're always going after the hyped up thing. So it's about getting a portfolio that is diversified, investing regularly, and then ultimately being in a portfolio that is ultimately tied to your risk preference, so you can hold it for longer rather than feel depressed because the returns are not good enough, or too excited because the returns are, where you feel like you must take profit every year, right?
Those are some really good points there, Ken. But Pauline, I would love to get your thoughts on this as well. And also about the emergency funds. Where would you, I don't think you answered that. Where would you recommend people put their emergency funds? And then let's talk about the expected rate of return and what kind of investments.
So the emergency fund, I will recommend in either FD or a fixed income fund. So you can have like a combination. So you can have part of it in the FD, because I always believe that although the FD rate is very, very low, but then that cash will give you a kind of a security. And then another part is a fixed income fund. And nowadays we can get different types of fixed income, and the expected return for fixed income can be like last year was about 8 to 9%. And then this year we're looking at 5 to 6%. Historically, fixed income can be 4 to 6% depending on what funds that you are looking at. So these are the low risk, and then it will protect your capital. And at the same time, if you have that extra, if your emergency fund is large enough, because it also depends on how large is your emergency fund. So if your emergency fund is large enough, you can even have like 10 to 20% of that part of the portfolio into a more aggressive investment instrument, because that will give you the 80% is to give you the protection, okay, to protect the capital. That 20% is for you to generate that extra return. And usually I would recommend the technology related or US global technology related funds, which will give you that kind of extra return. And so if I were to look at the expected return, I would think that no matter whether you are in a COVID environment or you are in a normal situation, the expected return in historically that we can see that for the equity market is about 7% compounding, and the US market is about 10%, 8 to 10% compounding. If you were to look at when is the best time to enter, like going for a market timing, I will have to say that it's a very, very difficult and tough job, because when we look at historically for the past 10 years, which are the years that you actually had a positive return. And then if you to look back at the past 10 years, you can count for Busan, Malaysia, and also China market, and many of the regional market. We only have about 3 years that are positive, and that were 2013, 2017, and 2019. These were the positive years. And most of the years are either flat or down. So that means investing, if you're trying to time, is very, very difficult. And except the US market for the past 10 years, it was a bullish condition. So it makes investing very, very difficult. And then that means that you need to really diversify your portfolio. And then you need to invest on a regular basis. That means you will have to shift your being price conscious. And because usually when we go for market timing, we are looking at the pricing. So when the price is low, then you go in, and the price is high, you sell. So you are looking at the price. So, and that will, based on our emotional influence, then sometimes we will make the wrong decision. Because usually when people invest is when they're very optimistic, and when they're optimistic, they feel that they want to invest more, and that's the time when the market is high. So you cannot time the market. So I would prefer you to look at diversification in terms of the time instead. So you are looking at you switch your focus on the time diversification rather than the price diversification. So in the time diversification, that means you will have to invest on a regular basis. So no matter if it's up or down, you don't care. You just have to invest on a regular basis. So if the market is up, then you buy less units. And then if the market is down, then you will buy more units. I'm looking at the funds. So in this way, you will be able to smooth out your cost. And in the long run, you will be getting a more consistent return. Okay, so and the expected return will be what Ken said will be fixed income is about 5, maybe 4 to 6 or even 7%. And then the equity market depends on which market. If you are looking at the current situation, the China, in fact, this year is exceptional, because we see our clients' portfolio increase 10%, 20%, 30%. So this year is rather exceptional, because if I were to ask you, when was the last time you saw your clients' portfolio to increase such a big extent? And you probably have to think that that was like 2009, the last financial crisis. So we shouldn't take this year expected return to forecast into the future. Historically, the equity is about 7, depends on which market, and then the US market is 8 to 10, and emerging countries market will be more volatile. Yeah.
Right, and I think one of the basically this reminds me a lot of this one line I've heard. I can't remember. I think a lot of people have taken credit for this, so I won't quote it. by anyone, but it's basically time in the market beats timing the market, right? For most people, that's going to be timing the market is a fool's errand for most people, at least, because it takes a lot of guts to do it. I mean, if you were in the eye of the storm, was it February 20th or 21st when when markets were down at their very, very lowest? I mean, it's easy to look now and be like, oh, should have bought it then. But in that time, it was very volatile, very uncertain, and a very, very scary time. It's very easy to look back and be like, oh yeah, I should have done it. But now it's when you were in that moment, trying to remember how it felt. And if you've just joined us, my name is Roshan Kanesan, and this is another BFM Personal Finance webinar done in collaboration with the Financial Planning Association of Malaysia, FPAM. And on this evening's webinar, we're taking a look at regular investing. And the first point we touched on is whether you should pause your regular investment if cash flow is tight. Right now, the conversation is, I'm having this conversation with Pauline, Yong, licensed financial planner with Sigma Wealth, Wong Wai Ken, Malaysia country manager of StashAway, and Malek Ali, founder of BFM Radio and filife. The conversation has now moved on to the structure of long-term investing and the benefits of staying in the market and the different, I think this was kicked off by a few questions from the audience. So if you've got any questions, please feel free to ask us in the comment section down below. We are more than happy to take up the questions you have. So I guess this kind of really circles around to the fact why people shouldn't stop their regular investment plans. It's keep staying in the market, it's tapping into the long-term compounding effects of the market. If we take a look at returns, I think some of the numbers you guys brought up were the fact that on equities are 7% per annum over the long term. US markets are 10% per annum over the long term. And we shouldn't use this year's expected return as a gauge for what future returns could be, right? This is one of those outliers. I think let's take a look at, actually, before we get there, Ken, on the StashAway platform, with all the volatility and uncertainty that we've seen over the last 6 months, 7 months, what has the investor behavior been like there? Because, I'd be curious to know.
Yeah. So I think I want to add on something that Pauline mentioned earlier, and then address your question because it's somewhat related. So regarding timing the market, I think we are in a very, very special year for a lot of different reasons. And, when markets really hit a low in March, what you do or don't do in that situation will really depend, shape the way of your portfolio going forward. So for example, if you had just left your money in the S&P 500 this year, you would actually be up 8%, right? Any other year, you take that 8% and be happy with it, and we're not even done with the year. But then, some people obviously will feel very emotional about the whole situation. We saw many, many big dips. And if you happen to miss 5 days that had really, really mega gains, like 10% gains, 8% gains, 5% gains, if you miss 5 of those days, your portfolio will be 30% down. So 8% up versus 30% down really depends on what you do. And it's really difficult to do the right thing because some of the best days are right next to or close to some of the worst days, right? So I don't know whether you all remember, but there was a day in March or early April when the market was down 10%, very next day up 12%, right? So like if you missed the 12% and you did what everyone else did, which was sell at 10%, then obviously you would be minus 30%, as I mentioned earlier. So obviously it was a very scary period for our investors too in March. And we are invested globally, right? So that's the US market included across different asset classes, equities, bonds, gold, and real estate. And it was very scary in March, but then obviously in that period, we saw increased withdrawals. But since then, in April, things start picking up again. And then people who invested in April said, hey, we're making tons of gains. And then they told people, and then basically in June, July, August, we've had 3 consecutive months of all-time highs now. So, things have really picked up again. And I think, basically it's because markets obviously have improved. People talk, people like to show people their apps when it's a green color sign over there. When it's red color, you're very shy, right? But when green color, you show everyone, right? So there's that. But also I think StashAway has been in the market for, close to 2 years now. So we're quite stable. You can see the track record and all that. So things have actually picked up and we are at all-time highs.
I'd be, sorry, Malek, yeah?
Yeah, anecdotally, Ken, I'm just wondering whether you find that people are people doing StashAway in addition to investing in the retail stock market, or is it an either or? Sorry Ken, I'm not investing in StashAway because I'm investing my money now in buying shares on Bursa directly. What's your what's your anecdotes as you speak to clients and customers, etc.?
Yeah. So most of our clients are within the 30 to 35 demo, and a lot of them are professionals in the banking, legal, consulting industries, right? And also tech. So these people are usually quite busy and they have very little time to actually stock pick and actually monitor on day to day, especially since the glove sector was so red hot over the last few months, right? So the ones with which we are seeing actually use StashAway on top of investing themselves is some of the high net worths. No one, as Pauline will know with your clients, no one high net worth is the same, right? They're all different. Some are business owners, some are stock pickers, right? So some high net worths actually use our platform to diversify globally, but at the same time, they love stock picking. So we actually see them kind of do both. And we actually see on the whole, actually 40% of investors do recurring investments because we do have that feature that allows you to do recurring investments every month. So it makes it kind of very easy to set and forget, right? And we are seeing that people actually invest 25 to 30% of their take-home pay into StashAway. So it's around StashAway being, robo-advisors being a thing for kids and all that, or small spare change, it's not really that kind of profile that we're seeing. So things are looking good, and depending on the demo, they're doing different things.
Curious, of those people that stuck, like, do you have any demographic information about during the market dip? Do you see any correlations between certain demographics, whether high net worth or the professionals that stuck around?
That's a really good question. So I have some hard stats and then I have some anecdotes. So we issued a report last year, and last year we had a correction being minus 20%, which looks tame compared to this year's bear market, but it was a correction nonetheless. So in that correction period, we actually saw people who were systematic investors actually made 11% gains, but people who were irrational, who kind of like checked the app a bit too often, went in, went out, they actually locked in losses of minus 2%. So that's last year's data. This year's data we've yet to compile because the year's not done yet, but anecdotally comes down to experience. So in the down period, you are actually 60% more likely to stop your regular investment if you're inexperienced, or you are 2 times more likely to sell in a bear market if you're inexperienced. We actually had some of the biggest inflows, the biggest deposits made to us in March and in April, because some high net worth individuals were like, Ken, here's a few 100,000, here's a few million. Help me grow my money. This is the bloodbath I'm waiting for. Right? They give me these big checks, right? So you see, high net worth investors, they really know what they're doing, and obviously they're very cashed up. So they were waiting for this. They didn't know it was going to come, but when it came, they had that conviction to go in. Whereas some inexperienced investors actually did chicken out, but I hope, learn from it, right? No right and wrong, just learn from it, and we're always there.
Hold on, let me just digest that information for a second.
I'm just imagining them, forget this app. Let's just give you a check, just bank it,
This is the quote that I'm stuck with is, this is the bloodbath I've been looking for. It's like, these are the people who were cashed up for years and years waiting for the big thing to happen, right? The repeat of 2008, 2009. Everyone wants to be Warren Buffett, buying the banks on like pennies on the dollar back then. But I think this, again, the points that you've brought up there, and you really highlighted some stats about the regular investment. Now, things like dollar cost averaging, I think that's the thing that we're going to get to in a bit. But these are not perfect strategies, right? There's no perfect investment strategy, because if there was, everyone would be really, really rich, and we would see ungodly inflation, I think. But we have strategies in place to manage based on our own needs. So one thing that you mentioned there, Ken, that I really relate to is that I don't have the time to think about these things, right? I don't have the time to sit in front of the screen and monitor the charts and the graphs and take a look at the PEs and all the different things that kind of play into the calculations and the stock picking and the like. And that's why we do dollar cost averaging. It's not perfect. Pauline, when we take a look at long-term investing, so dollar cost averaging is one of the strategies. What are the other things that we should be paying attention to when we look at long-term investing? Do you have any thoughts on this?
When we're looking at long-term investing, the very first thing is that you have to be committed. Okay, committed as in you want to treat this really as a long-term kind of event and not like halfway then you change your mind. So the number one is committed, and number two is being disciplined. Okay, so because it's long-term, so you need to be disciplined enough to follow your plan. And number three is to be patient. Okay, a lot of time people do not have the patience, and then they just want like an overnight gain. Today I invested, tomorrow I want to see it gain, and then or this year I invested, next year I want to see the thing having a positive return. But as I have shown, it's not easy to have a positive return, because over the years we have seen that there are certain years that we are flat or down, and then only a few years that we are having a positive return. So then that means that since you cannot time the market so well, then you might as well stick to it and then treat it as a long term. Because since we treat our property investment as long term, why can't we treat this unit trust investment as a long term? Okay, you just treat it as a long term and then make it like a systematic way to invest, rather than timing all the time. You need to time the market. So one good systematic strategy will be the dollar cost averaging. Okay, then you can on a monthly basis, you just invest a portion of a certain percentage of your salary into a fund, and the selection of fund is that you just need to select an above average fund. You don't have to select the best fund, because sometimes this year this fund is best, but then next year it could be not the number one. So as long as for the past 1 year, 3 years, 5 year, 10-year track record, it shows that it has been consistently outperformed the benchmark and above average return, then you can select those funds and then you can stick to it for a longer time period.
Yeah, I found a stat that I was looking for. So at the peak before the GFC, the S&P 500 was trading around 1,525 points. Today, it is 3,500 points. So it's more than doubled since the height of the pre-GFC numbers there. So if you were employing something like dollar cost averaging and you were buying, let's say on a monthly basis, S&P 500 ETF every month during the lows and continue buying during the highs, and you're doing it on a regular basis, what you're essentially doing is you're diversifying over the timeline. Am I right there, Pauline?
Yes, correct. You're diversifying the time as well as the price.
Yeah, so that's why you've got to keep the amount consistent. You've got to keep the regularity consistent, because you don't want to change too many things there.
Yeah, and of course, it's a commitment. Overall, it's a commitment that you need to stick with it. Yeah, and the return will come to you. You don't have to worry too much about the return. The return will come to you, because when you're a long-term investor, the time is your friend. You have the time to let it compound. So the time is your friend. And the important is the funds. If you were to choose a fixed income fund rather than an equity fund, you can see that over the time, because of the compounding, the fixed income fund will give you a much lesser return than that equity fund. So if you have a long years to compound, right, I would prefer you to go for equity funds. It makes much sense. Otherwise, if you want, you can also construct a portfolio whereby you have a 50% into fixed income and then 50% into equity, and then you can at least have that 50% of protection there.
Right. Yes, Malek.
Yep. Just wanted to surface a question on Facebook again, on Facebook Live again. This is from Jimmy Tan. We'd like to know, we talked about just now about market crashes. I think you talk about things. So there's a specific question for Ken about whether StashAway's robo-advisor, how would it actually mitigate the risk of a severe market crash? Does the algorithm do anything special, or is it just status quo based on the asset allocation of the portfolio?
Yeah, so we change it dynamically, but what we don't do is change it like every day, and we don't change it tactically. You know, you don't wake up in a cold sweat and then tinker with the system and say, hey, it's gonna mitigate things. It's not a silver ball. It is not a, you can't see the future with it. So what it actually does is that it has a preset logic, right? So that it optimizes your portfolio to give you the best portfolio for that economic environment, right? So in theory, what it's meant to do is to look at the economic data and say, okay, it's sunny outside, go outside with a singlet. If it's cold outside, go outside with a jacket, right? So that's what it's meant to do for your investments, right? Obviously, it's a lot more difficult to do that in real life because you have different kinds of data, economic data being one, your financial data, which is financial market data that's forward-looking. So we combine these few things to give you a optimal portfolio given where we are. So for example, right now, where we are is we don't want to say it maybe, but we are probably in a recession already, right? Globally and maybe in Malaysia. We just have to wait one more quarter for the backward-looking results, historical results to come out. So we're probably in a recession already, but markets are not pricing in a deep recession. They're pricing in an average or mild recession. So if you go too secure, you go too safe with your assets, you would have missed out on the rally. So what StashAway is currently positioned is what we call a fair weather, an all-weather strategy, where 50% of asset allocation is more growth-oriented, 50% a little bit more protective, more recession-proof, so to speak. So you will see also from day one that all our portfolios, all 12 of them, are very, very diversified. So regardless of which one you choose, in a tough market, it won't go down as much as the benchmark because you're so diversified already. And the data is out there that show that diversified portfolios actually accumulate a lot more value over time, purely because in bad times, it doesn't go down as much. It's not rocket science because it's not concentrated. It doesn't go down with, let's say, all the way down with the S&P 500. So it takes less time to recover, and then you have more cumulative gains. So StashAway uses diversified portfolios as well as systematic logic that's based on economic data to then craft your portfolios. So it's not a silver bullet, AI, whatever, see the future. It's definitely not that. It's just a systemized way of investing, and there's a lot more information on our website.
Okay. There's one more follow-up question on that. From hold on, the thing move. Sorry, just a second. I lost it. No, I didn't. So it's from Marcus Lowe. Does robo investor such as StashAway advise investors which fund is good for investing? No, you don't do that, right?
So what we do is we have 12 funds of our own, and we guide investors to a particular fund based on their investment objective. Let's say you want to retire in 20 years, we will recommend something a little bit more aggressive. If you want to do something in 5 years, then we will give you something a little bit more balanced. So we have our own funds. We don't actually do fund of funds right now or specific unit trusts, right? So we have our own funds.
All right. This is now a question for Pauline. Pauline, is it, if you to got a regular investment savings or investment plan, is now too late a time to start investing, to create a regular investment plan?
The good thing about having a regular investing plan, there is no too late. Every time is good timing. Okay, so that's number one. So that means you can always, anytime you just open an account. And then I did one calculation with my client. I show him. So I said that if you were to invest for your children, let's say your son is 15 years old, and then you want to inculcate this savings habit for him. So you tell him that when you're 15 years old, until before you go for work, mommy will have to invest for you on a regular basis. And then once you get out of work and then you start earning your money, then you will have to continue this savings habit until you are 60 years old. And I did this calculation every month, 200, and 15 until 60 years old. So we give one example is to invest in a regular equity fund, which is 7% of a return, and that will give you 800K. Okay, 800,000 at the age of 60 years old. Now, if let's say you wanted to invest in US market, okay, say you want to invest in the US market, and that will give you 10% of compounding. And if you to use 10% as compounding, and then your return will be 2 million. Okay, and say for example you want to invest in a technology fund, and technology fund gives you about 14% for the past many years, 5 years. So if you to invest in the technology fund, and that will give you 8 million, okay, by the age of 60 years old. So you can see that the funds, the choice of the fund will actually and plus the power of the compounding will actually create much more wealth for you in you know, for this regular savings plan.
Okay, a follow-up question from Tan Teng Huat on Facebook Live. So you mentioned basically about your the child who's 15 years old till 60, but yeah, but he's questioning, you know, don't you think the age gap is important also when you emphasize monthly investment? So for example, a slightly older person who are maybe in their 40s or even 50s, is this kind of like advice which is too late to set up a regular investment plan when you are 50 years old? You know, because the power of compounding is over a much shorter period, you know?
Yeah, so when you're looking at a shorter towards when you're 40 years old, and then you are looking at only 20 years of compounding, and in fact 20 years is also good enough for compounding for you, because you are, if you look at the past historical cycles, right, every about 10 years we have one big crash, and then with this one big crash you probably will get more units with your regular savings. So I wouldn't be saying that it will be too late. It's just that the choice of your strategy, that means maybe for the first 10 years, because since you have 20 years, right, towards your retirement, maybe the first 10 years you can invest in equity fund, and which is more aggressive, and then the last 10 years towards your retirement you have to switch to an income fund whereby you want to protect your capital. So we can strategize that kind of investment strategy.
Yeah, I've also seen some financial planners actually they call it buckets. They bucket the so that, you know, anything that you, as you said, anything that you need in 10 years, right? They'll say, okay, the first 5 years, you know, you use bonds for that, bond funds for that. Anything you need in 10 years, you use equity funds. But then basically they work out exactly how much you need for your retirement. And then they kind of like, you know, say, okay, in 15 years, that one you can, things you need in 15 years, the money that you need when you are, you know, in 15 years time onwards, you can invest that in equities. But the money that you need earlier in your retirement, then you can invest it in more safer funds. So there is a technique for doing this, right?
Yeah. Yes.
Great. Roshan, over to you. Sorry, there's another question for for Aaron. We never can get away from the question about cryptocurrencies.
Only a matter of time, Malek. It was only
I know. It's just this thing, right? So cryptocurrencies. So I haven't been, Roshan, have you been tracking the movements of cryptocurrencies? I mean, I'm so like blasé about it that I don't even track it. What do you track it, Roshan?
I don't track it. I check it every once in a while.
Okay, where is it right now? Do you know? Do you know where is it right now? Is it is it off its highs, or is it off its lows, or you know?
It
is. Yeah, so anyway, let's move this to Ken. Ken, I'm sure, given that you work in the kind of like the same, I guess we're all in the same fintech industry, right? Of which a cousin, one cousin is your cryptocurrency brethren. What are your thoughts on cryptocurrencies, investing in cryptocurrencies?
I think it's obviously an exciting investment vehicle. I hesitate to say if it's an asset class because it hasn't been around long enough to prove what it's worth. But you know, some people think that wine is an asset class, some people think that paintings are an asset class, right? So cryptocurrencies, throw in the mix as for diversification's sake, why not, right? I think we all, so to speak, wanted to go to the moon. So, you know, it's all about diversification and putting an appropriate amount towards something which is that volatile, right? So I myself have a little bit in cryptos, and I think the use case from a mainstream point of view is not established yet. But what we know is that it's a great speculative vehicle, right? So it can just jump threefold in one day, and it can crash, in another day, right? So it's volatile, and it's for traders lah. But for those who are holding for long term, you just put half or 1% of your net worth there, and if you lose it, so what? And if you make outsized gains, then what you can do is, first of all, you call me and Pauline, and we will go makan. But then after that, what is left, you basically should pare down the gains. Let's say it was 1%, now it's worth 5% of your net worth, and you pare down the 4% and invest it in other things that are more safer, more established. So it's an exciting asset class, especially for the younger ones. But if you really don't understand what you're going into, there are a lot of scams out there, all these trying to raise money with these coins. I wouldn't touch that. I would stick to the very, very mainstream coins and use only licensed digital exchanges for these things.
Yeah. Okay. And Securities Commission has just given the green light, has greenlit a couple of those exchanges. Yeah. Great. Roshan.
Yeah, I've actually, on this note, I think one of those exchanges is Luno, and I spoke to the country manager a few weeks back. So the interesting thing about, and also a previous guest on the show, on the webinar, Rajan Devidasan of RD Wealth Creation, about understanding the behavior we're seeing, right? And cryptocurrencies, in particular Bitcoin, have gotten a lot more attention. One, because big investors like Paul Tudor Jones are looking at it, but also because of the unprecedented monetary policy that we're seeing, right? Everyone's looking for the next inflation hedge. And it seems to me you can break it down into older investors like gold, and younger investors seem to gravitate towards Bitcoin because of its limited nature. Pauline, before we move on to I think the last quarter, the last stretch of this webinar, what are your thoughts on Bitcoin actually, or cryptocurrency in general?
Okay, I would like to think Bitcoin as the time when we had the .com bubble in the 2000. So during that time when people were talking about internet, right? That was when everything most of us, we don't even have the internet, and then these companies, they are making they are not really making money, but then because of the Nasdaq, and then they push the prices really high. So I would think that currently. But then that doesn't mean that that .com internet is down and gone. 5-6 years later, it become a part of our daily life. So what I'm looking at this Bitcoin is that probably we are at that situation because we're at the infancy situation whereby lack of regulation rules, and the structure is not stable yet. So we are still not able to make it well received by everybody. But I believe maybe 6-7 years later, it could be part of our daily life. So that means when we travel to country, we don't have to exchange rate. We don't have to bother about exchange rate anymore. We just use like a digital currency, which is Bitcoin. And then we will, it's like something like it will be part of our daily life. So I would think that there is a possibility. So I would not saying that I will completely shun away from Bitcoin, but I will just look at it as some like a diversification. But it's not like I will not pick too much of attention at the moment due to its lack of regulation. But maybe 5 years later, I would see that this could be a very common thing that every one of us are looking at. Yeah.
Lynette has chipped in and said, Luno is licensed under the Securities Commission. So if you want to invest, and as like what Ken says, beware of scams. Waikit Lau has said that I think he's just said here 11K. I presume that's his that US 11,000 is the price.
US dollars, yep.
Bitcoin at the moment. I think there's Aaron Ho also who commented that basically it would be nice to have a hybrid fund that would have 1 to 2% in crypto. Suggestion for you, Ken. And yeah, so I think those were the comments from the floor. Over to you, Roshan.
Yeah, I think let's round it off with the discussion of dollar cost averaging, value averaging, and the things you need to pay attention to there. But if you've just joined us, this is a BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia, otherwise known as FPAM. My name is Roshan, Kanesan, and on this week's webinar, we're exploring we started off by talking about if cash is tight, should you be pausing your regular investments? And the conversation has gravitated over to the benefits of long-term investing and the different strategies to work that out, alongside the variety of questions that we've gotten from the audience. Thank you very much for that. To help me with this discussion this evening, I've been speaking with Pauline Yong, licensed financial planner with Sigma Wealth, Wong Wai Ken, Malaysia country manager of StashAway, and Malek Ali, founder of BFM Radio and filife. As we're about to wrap up, put in your last minute questions and we'll try to get to them in time. But let's end off with another form of strategy, right? Is the value averaging strategy. This is something that's I've heard people basically diminish the value of dollar cost averaging, saying that it doesn't really work if you don't value average as well. I don't know what the merit of that argument is, but I mean, from a theoretical basis, value averaging sounds great, right? You buy in the low, and then you keep it going. Every time the market dips, you buy again, you buy again. It's not that easy to execute though, because it requires like nerves of steel, and right, that's why dollar cost averaging is the go-to for most people, because it's a mechanical strategy and you don't put that decision on yourself each time. Pauline, could I get your thoughts on the differences between dollar cost averaging and value averaging and comparing the two?
Sure. For the dollar cost averaging, we are looking at the fixed amount of money to be invested on a monthly basis, on a regular basis. It could be monthly, it could be quarterly. So it's a fixed amount of dollar. It could be 100 ringgit or 200 ringgit. So it's a fixed amount. Whereas the value cost averaging, and this strategy is actually looking at when the price is down, okay? When the price is down, you are actually buying more units. And then when the price is up, you are buying less unit. So I would look at these two strategies. They are both great strategies. It's just that the execution part, the value cost averaging is a rather difficult strategy to be able to execute smoothly. And because that would require you to do some form of a market timing, because as I said, there's very difficult to time the market. So it's very difficult to execute. So I would recommend dollar cost averaging because of that simplicity of it. Yeah.
Ken, what are your thoughts on this?
Yeah, I think with human emotion and investing, it's very fraught with a lot of danger. So what you should do is to use systems, in Pauline's word, discipline, to actually pre-program some responses so that when certain things happen, you know what immediately you should do. Whether you do it or not, that is the vagaries of human behavior. But let's say you have a pre-programmed response to say, when the market is down, I invest a certain amount. I think that's a good way of going about it. So let's just say, we start with the normal dollar cost averaging, as Pauline described. Every month you put a certain amount, right? And then on the other hand, you have value cost averaging, where you have to basically track the market. And if, let's say, it goes down 10% according to when you first started, you invest 10% more. And then on the inverse, if it goes 10% up, then you invest less. So in theory, actually, value cost averaging would actually give you better percentage returns. But say you value cost average in a bull market, you're actually investing less and less and less and less, right? So you might get great percentages, but your actual nominal number might be small, right? So what you should do is maybe somewhere in between. For example, if you see markets, let's say, fall outside the normal range, let's say for that day, let's say fell anywhere more than 3%, right? Then you put in a certain amount that you already pre-programmed in your head to actually take advantage of the down market. So that's a little bit of a hybrid approach between DCA and VCA. And it's also easier to do because when you see the market go down by 3 to 5 to 10%, as you saw in March, you'll be scared. You'll be very, very scared, right? It's best you wear dark color pants in those times, right? So people don't know what's going on, right? You'll be very scared. So instead of being like so kanchong and being so worried, your pre-programmed response tell you value cost average. So the next day, put in 1,000, whatever you can spare, or 500, whatever you can spare. So that your pre-programmed response scratches the itch of doing something, but at the same time, you know that actually going in when the market is a dip will not only rebound very soon, but also you can pick up a lot of stock for cheap, right? So another distinction here is there is a difference between buying into an index or buying into a ETF versus, say, buying into one particular stock. Value cost averaging into one particular stock, very dangerous. Okay, so what I'm saying as a fund manager is to value cost average or dollar cost average into the stock, into a fund or an index, not a stock.
There's one more question for you, Ken. On a slight tangent to DCA topic, will StashAway be considering some form of target dated funds for those goal-based portfolio, or a manual risk adjustment will still be the way to go? I don't understand the last part, but maybe you can attempt to explain the whole thing to me.
So basically, we have ways in our StashAway platform where you can actually not to say commit, but you can actually choose a fund based on your investment goals, say which ends in 5 years, where you put a down payment on a house, buy a new car, send your kids off to college. So the suggestion is that maybe when the 5 years is up, you automatically sell, or you de-risk as you reach that goal. Those are really nifty features. We're actually looking at it for slightly long term, like for retirement planning, say every 5 years you automatically risk down, so you get more bond allocation as you grow older, which is great for de-risking as you end your accumulation phase, right, so to speak. That's something we are looking towards, but right now you can actually switch it manually for no additional cost, right? So every few years you can always risk down or risk up, no matter what your preference is. But that's a really cool feature. We're looking at it. We only want to do it if it makes sense for the customer, and we want to only do it if it's for very, very long term, let's say 10 plus years of investing.
I mean, there's a hack, right? I mean, but judging, I can have 4 portfolios in StashAway. This is my 20-year horizon. This is my 15-year horizon. This is my 10-year horizon. This is my 5-year horizon. And I put in those things because that 5 years I'm going to use up. I'm going to spend that in my first 5 years of retirement. And then I don't need the 10-year one yet, right? And then I switch. Once I withdraw the first 5 years, I switch everything back, kind of like move it 5 years, right? So there's a thing that you can do, possibly. Okay, great. I think we're okay with the questions here. Fantastic questions from our audience. Really appreciate it. Really enjoyed it's part of the fun of doing this is answering questions, which is great. I'm actually thinking about doing a series on sort of, I am so and so, and this is how I invest. And it'd be great to involve some of our Facebook Live participants in those discussions. Maybe we can even do a case study, right, Pauline, of someone who wants to put out their financial information, and we can do a complete, not complete, but at least some suggestions about how he or she can.
That would be great.
Yeah, great.
I think what we can also do, Malek, is to highlight maybe some brave users, brave listeners, or experts who maybe made mistakes before, right? Those war stories are always fun to hear. And not many people in investing tell the world when they lose money. They get very shy, right? But when they make money, I made 10% on this IPO or whatever, but you don't call me, right? What's the point? But I did this, I was greedy, right? And I think those are great human interest stories that I'd like to hear about as well.
Well, I lost one day. I lost the opportunity cost of 7 figures in 3 days.
Wow, I was about to talk about how I invested at GoPro at the top of its price at $60 and how it's $5 now. But Malek, that one takes the cake, lah. But that would be very interesting. I think it's a very good angle to talk about, right? Survivorship bias is a very, very big thing. We talk about the winners when it comes to business, when it comes to investing. We don't often talk about the fact that there are many people who have lost out. And on that note, I think I want to reiterate what Pauline said when it comes to investing, commitment, consistency, and patience being those important elements to it, right? Take a look at any index over the long haul, the S&P 500, the MSCI World Market Index. And over the long term, over the last 80 years, 70 years or so, the market has always gone up. Have that patience to realize that even though the even though you're in the eye of the storm, trust that unless the world economy, the entire world is going to come to an end, that eventually the market will come back up. And on that note, thank you, Pauline, Ken, Malek, for joining me today. To all the viewers, thank you so much for your time on a Tuesday evening, post dinner. Thank you so much for spending it with us. Now, if you want to catch another BFM webinar, we've actually got a health and living weekly webinar happening this Friday at 12 p.m. It's called Sleepless Nights from COVID-19. I'm going to guess that it's about sleep and some form of how to get better sleep from that. And this is with Dr. Jivanan Jahendran, consultant ENT surgeon at Pantai Hospital, Kuala Lumpur in Cheras. Definitely something you want to catch. That's at 12 p.m. again on Friday. And on that note, thank you to everyone who's joined us this evening. We'll see you next week once again.